So stocks are lower in part as China tries to rein in inflation by telling its banks to raise their capital requirements. And as we told you, both the U.S. and China staking out their economic position as a new Cold War takes shape. How do you navigate what's going on to maximize your investment portfolio in light of all that? Joining us now is Rob Russell from Russell & Company, and also Mark Travis. He manages the 5-star rated Intrepid Capital Fund. The fund is up 12.35% year to date. Gentlemen, thank you so much for joining us. Mark, I'll start with you. How do you invest in light of everything we just said?
Melissa, frankly, the same way we have for the last 15 years, from a bottom-up basis, looking for businesses that generate a lot of free cash flow with very sound balance sheets. The things that I like to say are things that people need and use. A lot of times mundane, maybe not growing very quickly, but we think represent discounts to what the business is worth in a private equity transaction.
Yes, but Mark, given the international headwinds right now, given what's going on in Europe and concerns about Ireland spreading over into Portugal, given what we're seeing with potential trade wars there in China, are you starting to think at all about a more domestic-centered portfolio?
Well, Trish, I would say mine is definitely a domestic-centered portfolio. I occasionally will put money overseas, but it's more of a rarity than the norm. But
how does that help you right now?
How does what help me?
Having a domestic portfolio.
Well, again, we're a dollar-based investor. The challenge is, you know, with Mr. Bernanke's QE2, our dollar value is dropping. But you know, I think that there's still plenty of opportunities. The volatility that's likely to occur if we have a trade war or some type of sanction that Chuck Schumer will put on the Chinese, I think would be an opportunity to put money to work, frankly.
Rob, you say based on this whole environment, you think it's a bad time to be in bonds. Why?
Yeah, I do. Here domestically, it's a terrible time to be in bonds. You're holding bonds. You're at a high, and investors always get it wrong. They buy high and they sell low, and right now they should be exiting bonds here domestically. I think the opportunity is where you go where the growth is, and of course the growth isn't here domestically. The growth is overseas, and you got to be picky about that, of course. And when you talk about bonds, if you like the characteristics of a bond, you know, the yield and the stability of the bond, you want to look overseas more in the emerging markets.
Yeah, I see you like Indonesia. What else do you like?
Yeah, I like the supporting nations of China. It's okay to invest in China, but, you know, it's one of those things, again, I'd rather get in when the action hasn't been, you know, fully evaluated. And I think Indonesia is a great story. Chile is another one, the world's largest copper producer. They're helping fuel the growth in the other emerging markets like China. And then also, of course, you have Australia, which is a huge resource for minerals and commodities. So
unlike Mark, Rob, you're willing to roll the dice here on these international troubles, given what we're seeing with the rhetoric coming out of Mr. Bernanke and likely more to come from China, given what we're seeing in Europe. Does that not have you at all concerned about having an international portfolio?
Yeah, I think, you know, historically or traditionally, you compare investing internationally as a risky play. I think it's a more stable play right now when you compare it here to domestic. I mean, here with QE2, we're injecting money into the economy. We're adding to the supply of money, whereas China's doing the exact opposite. They're reining in the supply of money because they're growing, and you want to go where the growth is.
Mark, talk to us about your specific picks.
Well, just to add on to his comments, I feel like Obamonomics is, that's the Lilliputians, and our economy is Gulliver. And, you know, if we could get the taxes and regulatory climate set properly, we'd make Hong Kong and Singapore look like a bunch of pikers. But we've got a regulatory environment, a tax policy, and a wall facing us Jan 1 that's not constructive, in my view. But back to our picks. You know, Trish and Melissa, I'm sure you're going to send out some Christmas cards here soon, and I want you to think about me when you do it. American Greetings, ticker symbol AM. High $19 share price, about a 2.627% dividend, a lot of free cash flow on a $800 million market cap. Probably a double-digit free cash flow yield. I also own the credit, which is a 16 bond. I feel very comfortable with that credit. There's only about $100 million in net debt on their balance sheet, and I'll earn a little over 7% to that maturity.
All right, looks good. Thank you so much. Great stuff, Mark and Rob.